Hi everyone, welcome back to the channel. My name is Nakul and today's video is going to be all about the 2 ETF portfolio. Yes, you heard that right. We're going to go through a complete globally diversified portfolio of stocks and bonds made of just 2 ETFs. One total world stock ETF and one total world bond ETF. This isn't a portfolio for right now or for the next 5 years. This is a portfolio for all ages and all stages of an investor's life. We're going to go through the benefits of the 2 ETF approach, the details of the ETFs in this portfolio, a common asset allocation strategy, and finally, why this portfolio makes sense for some investors and doesn't make sense for others. This video is all about simplifying investing, which is exactly what this channel is about. So do subscribe if you find this content useful. We're trying to hit 1,000 subscribers by the end of the year. Let's get into it. An investment portfolio is a basket of assets that can hold stocks, bonds, cash, and any other financial assets. So technically, if you invest in only Google and Apple, that could be called a portfolio. If you buy only Tesla, that's your portfolio. But a well-balanced portfolio or a core portfolio should aim to maximize your returns by holding a diverse mix of high-risk and low-risk investments in a way that reflects your risk tolerance and financial goals. The two basic steps to diversifying your portfolio are to spread your money among different asset classes and then further allocating your money in different regions and sectors of those asset classes. By having different asset classes in your portfolio, you can protect your portfolio from losing value compared to if it contained only one falling asset class. For example, when stock prices fall, bond prices often rise or fall significantly less because investors move their money into less risky investments, causing bond prices to move up. Further, by diversifying your money into different regions and sectors of an asset class, you can ensure that one sector doesn't have a significant negative impact on your returns. For example, having a large portion of tech stocks before the dot-com bubble or a large portion of finance stocks before the financial crisis. The first advantage of buying this 2 ETF portfolio is diversification.
But Nakul, how can a 2 ETF portfolio give you diversification?
Let me explain. By just buying these 2 ETFs, you get exposure to over 9,000 stocks and 16,000 bonds all over the world. As Jack Bogle, the creator of index funds and the founder of Vanguard Group, said, don't look for the needle in the haystack, just buy the haystack. And that's exactly what a total world stock ETF and a total world bond ETF do. But more on that in just a few minutes when we go through the ETFs in detail. By buying only one stock ETF and one bond ETF, you avoid any portfolio overlap. You see, when you're buying multiple ETFs, you may think you're getting a significant amount of diversification, but the truth is many of the holdings in the different ETFs may be the same. For example, a US total stock market ETF such as VTI and an S&P 500 ETF such as IVV have a 99.4% overlap. And though you are getting significant diversification by buying these ETFs, you're not getting additional diversification by buying additional ETFs with very similar holdings. The 2 ETF portfolio is also an extremely low cost solution with both ETFs having an expense ratio of below 0.1%. The 2 ETFs in this portfolio are the Vanguard Total World Stock ETF, which has an expense ratio of just 0.07%, and the Vanguard Total World Bond ETF, which has an expense ratio of just 0.06%. Which means if you invested $10,000 into a portfolio of 50% equities and 50% bonds, you would pay just $6.50 a year. And most importantly, the 2 ETF portfolio is simple. It's simple to understand because you literally own one equity and one bond ETF. It's simple to track because you just have to track 2 ETFs. And it's simple to rebalance because you only have to buy and sell 2 ETFs. Now let's go through each of these ETFs in detail to really understand this portfolio. The Vanguard Total World Stock ETF tracks the performance of the FTSE Global All Cap Index, which measures the performance of large, mid, and small capitalization stocks of companies located around the world. It includes 9,551 holdings in over 47 countries, including both developed and emerging markets, and covers more than 98% of the global investable market capitalization. The FTSE Global All Cap Index is a market-weighted index, which means the larger the market capitalization of a company, the more weight they will have in the index. The ETF has over 60% of its allocation in US stocks, followed by Japan, UK, Canada, and China. Which makes sense because at current market weights, the US stock market comprises of about 60% of the total global market, followed by Japan, UK, and China. About 22% of the ETF is in the technology sector, followed by financials, consumer discretionary, industrials, and healthcare. The ETF's top 5 holdings are Apple, Microsoft, Alphabet, Amazon, and Tesla. Again, this makes sense since these are the 5 biggest companies in the world. The top 10 holdings make up 15.7% of this ETF. The ETF has a tracking error of 0.12 and an expense ratio of 0.07%, which means if you invested $1,000 into the ETF, you would be charged 70 cents a year by the fund provider. In terms of performance, the ETF has an impressive 10-year annualized performance of 10.2%. By the way, if you don't understand some of the terms in this video or want to know more about ETFs in general, you can check out my video on everything you need to know about ETFs. I'll link it in the description below. So just think about that. By investing into this ETF, you get exposure in 98% of the world's investable equity market, over 9,000 holdings, and the fund provider charges just 0.07%. This ETF holds all of the S&P 500 companies, 94% of the companies in the Nasdaq 100, and all of the large and established companies in the UK, Europe, China, and the rest of the world. Now, let's go through the Vanguard Total World Bond ETF. It aims to track the performance of the Bloomberg Global Aggregate Float Adjusted Composite Index, which provides broad, diversified exposure to the global investment-grade bond market. For those of you who don't know what investment-grade bonds are, they're bonds that are believed to have a lower risk of default and have been given a strong credit rating by credit rating agencies such as S&P, Moody's, and Fitch, because the bonds are issued either by large companies with strong balance sheets or by developed market countries. The ETF invests in short, intermediate, and long-term global investment-grade bonds through a unique ETF of ETF structure. Basically, what that means is by investing in this ETF, you actually get exposure to 2 ETFs. The first ETF provides you exposure to US investment-grade bonds, and the second ETF provides you exposure to investment-grade bonds outside the US. The ETF has 16,709 bonds and has a dividend yield of 2.8%. The ETF has 47% of its allocation in US bonds, followed by Japan, France, Germany, and the UK, with its largest holdings being different US government bonds, which comprise of about 33% of the ETF. The ETF has a tracking error of 0.06 and charges an expense ratio of 0.06%, which means if you invested $1,000 into the ETF, you would be charged 60 cents a year by the fund provider. The ETF was incepted in 2018 and has an annualized performance of 2.23% since inception, which may not seem like a lot, but remember, your bond allocation is supposed to provide you with regular income, stability, and diversification, and the primary capital gains of your portfolio will come from your equity allocation. In combination, these 2 ETFs form one of the simplest globally diversified portfolios that is easy to manage, low cost, and easy to rebalance. In terms of how much of each you should buy, a common asset allocation strategy to mitigate risk is for an investor to subtract their age from 100. Then use that result for the percentage of stocks in your portfolio, with the rest invested in bonds. For example, if you're 25 years old, you would invest 75% in equities and the remaining 25% in bonds. As you age, you transfer stocks to bonds based on the 100 minus your age strategy. The stocks give you opportunity for growth when you're younger. It also gives you time for your gains to compound. Then when you're older, the bonds can provide you with stable income and less volatility. So when you're 20, you can have 80% of your portfolio in equities and 20% in bonds. When you're 50, you can have 50% of your portfolio in equities and 50% in bonds, and so on. You don't have to adjust your asset allocation every year, but you can adjust it every 5 years. So it can be 80-20 when you're 20 years old, 75-25 when you're 25 years old, and so on. But do remember to rebalance your holdings back to your target allocation on a yearly basis. If you consider yourself a risky investor or a risk-averse investor, you can adjust the asset allocation to something that makes more sense to you. But be cognizant that if you have a riskier asset allocation, you must be able to stomach the volatility that comes along with it during recessions and bear markets. Overall, this is how your portfolio could potentially look over different ages of your life if you use this common asset allocation strategy. Now, as mentioned before, this portfolio isn't for everyone. The 2 ETF portfolio is what is called a lazy portfolio. Now, in investing, having a lazy portfolio doesn't mean that you don't care about your investments. Instead, it means that you've created a portfolio that can continue generating long-term returns regardless of what is happening in the market at any given time. It's a portfolio that more or less runs on autopilot, except for the rebalancing you have to do once a year, the changes in asset allocation every 5 years, and obviously adding to it on a consistent basis. But it does mean that you have to have a very passive approach to investing. You can't tactically overweight a certain country or a certain sector because the ETF is going to invest into different regions and different sectors based on a market weighted approach. So this portfolio makes sense for those investors who don't want to spend time analyzing the market or are too busy to do so, and not for those investors who have itchy fingers and want to make tactical bets on different stocks. For example, I personally prefer to have a higher weight of China and India in my portfolio, and so I hold more than just two ETFs. Let me know what you think of this two ETF portfolio in the comment section below. Is this lazy portfolio something you would invest in? I hope you found this video useful. If you did, do smash the like button. If you're looking to learn how to pick the best ETFs yourself, here's a 6-step guide on how to pick the best ETF for you. I'll see you in the next one.